For this week's Smith Business Close-Up, we are on location at the University of Maryland's Robert H. Smith School of Business. And joining us is Cliff Rossi, who is a professor of the practice of finance. Thank you for being with us.
Thank you for having me.
We want to drill into what's happening with Fannie Mae and Freddie Mac. And Congress is looking at making some major changes. Maybe I should start with how that's important to homeowners.
The first and foremost issue for them is that it will affect mortgage rates, and it will affect their availability of credit, their accessibility of credit. And we think that the new law, if it goes into place, will actually cause mortgage rates to rise by as much as 0.5%, which is pretty significant.
Those two entities, Fannie and Freddie, probably became best known to the public around the time of the housing crash. To what degree were they responsible, or why do they need to be replaced in the first place?
Well, that's a great question. In fact, there are a number of people out there, experts, that would say exactly that. Why should we change something that really worked very well for a very long period of time? But what happened was a number of things. Back during the boom years, we call it, of the pre-2007 period, there was a lot of bad underwriting going on, excessive risk-taking, and not the least of which was that these two entities actually increased the size of their portfolio of loans that they were actually holding, which was never really supposed to be part of their mission in the first place, boosted their profits, kept on taking more risk, and as they say, the rest is history.
How is it that they keep interest rates, mortgage rates, low currently?
By virtue of the fact that right now they are in conservatorship under the federal government's watch, and even before that there was an implied guarantee that should something happen, that taxpayers would actually surge in and cover them for losses. What that does is that reduces the cost of funding for those two entities to actually finance mortgages, which in turn gets passed on to home buyers.
So Congress doesn't want to just wipe the slate clean and do away with that entirely, do away with a government guarantee entirely, but what I understand is it would scale it way back?
Oh, correct. Right now I think the numbers are something on order of 90+% of all mortgages that are securitized into a mortgage-backed security today are done so either through Fannie Mae, Freddie Mac, or Ginnie Mae. And that's just simply too much government involvement for most in Congress to tolerate. So what's happening under this new proposal is that they will require private investors to absorb the first 10% of losses before the federal government would actually come in and take over any losses after that, which is a sea change in terms of the way in which we securitize and actually finance these mortgages, because right now it's effectively a government-financed process. Going forward, it will be largely a privately financed process.
What would this mean for local bankers in Maryland and around the country?
Yeah, so there are actually explicit provisions in the new legislation for carve-out, if you will, for small lenders, community banks, for example. And what it will allow them to do is to securitize more directly than they have had a chance to do in the past. It'll also give them an ability to finance the mortgages more readily. It will allow them to just be able to take advantage of things that large lenders have traditionally been able to take advantage of much easier because they have scale.
If this goes through and it's an election year, what's it going to mean for the process of getting a mortgage for an individual?
Well, really, folks shouldn't see too much different than what we see today. It's harder, certainly, to get a mortgage than it was before 2007, simply because so many lenders have tightened up their underwriting standards, requiring more down payments, better credit histories, and so on. On top of that, the federal government has implemented a number of new rules that suggest or pretty much tell lenders these are the minimum quality types of loans that we think you should be doing. That said, with this change in the Senate plan, borrowers should see very little change in the way in which the mortgages are underwritten. They'll be much better underwritten than they ever were before, but the biggest change that they'll probably see is that mortgage rates will be higher than under the current system.
If there was one thing you could tell Congress to not mess up here, or some change you would like to see, what would it be?
I think it would simply be that the 10% requirement on private investors taking the first 10% losses is too high. If you put it in comparison to the mortgage crisis, 5% would have been sufficient to cover the losses that we experienced from both Fannie Mae and Freddie Mac.
Professor Cliff Rossi, University of Maryland, thank you for being with us.
Thank you.